Welcome to the deep dive. So the U.S. Treasury bond market has been, well, a bit unpredictable lately, hasn't it? Especially after President Trump's tariff announcements.
Yeah, definitely. Feels like some of the usual signals are a little mixed up right now.
And if you're listening, you're probably, like me, trying to get a handle on what this volatility actually means for the economy, for investments.
Absolutely. We've got a really interesting piece here from The Motley Fool. It just came out yesterday. The title is, Should You Avoid Long-Term U.S. Treasury Bonds Following President Trump's Tariffs?
Okay.
It's a perfect jumping off point for us to, really unpack what's driving this.
Right. So that's our plan today. Just try to cut through the noise, figure out why the bond market's acting this way. We want to give you a clear idea of what it might mean, without drowning everyone in jargon.
Sounds good.
Okay, so let's dive in. When President Trump first announced these big tariffs, what was the immediate, the knee-jerk reaction?
Well, initially, it played out mostly how you'd expect based on economic theory. The Motley Fool article points out these were pretty hefty tariffs hitting imports from quite a few countries.
Right.
So a lot of economists quickly dialed back their forecasts for U.S. GDP growth. The thinking was, higher costs for businesses, for consumers. That's likely to slow things down.
Makes sense.
Yeah.
Higher prices hit the wallet, economy potentially slows. And the financial markets, how did they react to that idea, the slower growth?
Well, traders pretty quickly upped their bets the Federal Reserve would have to step in and cut interest rates.
Ah, okay.
Yeah, the logic is simple. If the economy is looking shaky, maybe even heading towards recession as some were worried, the Fed usually reaches for rate cuts to try and stimulate things, get people borrowing again.
Okay, yeah, standard playbook there. Slowdown fears mean rate cut expectations. Now, when people expect lower rates, what typically happens with something like U.S. Treasury bonds?
Yeah.
They're supposed to be safe, right?
Exactly. Usually when there's economic worry, investors flock to safety, and U.S. Treasuries are, usually top of that list.
Mm-hmm.
So that increased demand normally pushes bond prices up, and the key thing to remember is that bond prices and their yields move in opposite directions, like a seesaw.
Right, the seesaw. Crucial point. Higher demand, higher prices, lower yields.
Yeah.
So here's the confusing part, the real head scratcher the article gets into.
Yeah.
While yields did dip at first when the tariff news hit, longer-term yields, specifically the 10-year Treasury, they've actually climbed quite a bit since then.
Yeah.
Nearing 4.5%. What gives?
Exactly. That is the central puzzle. And the Motley Fool notes that even after they announced a 90-day pause on most tariffs, though, importantly, not the ones on China, that 10-year yield stayed pretty high. It was sitting at 4.35% just last Thursday. So if the market is still kind of expecting the Fed to cut rates because of these economic worries, why are these longer-term yields pushing higher? It just seems off. It goes against the usual script.
It really does feel like a curveball.
Yeah.
So this leads to the big question the Motley Fool asks. Given this weird behavior, should investors maybe be avoiding longer-term U.S. Treasury bonds right now? What's actually causing these higher yields if it's not optimism about the economy?
Well, the article digs into a few key factors. First, it's a good reminder that while the Fed's target rate, the federal funds rate, has an influence, Treasury yields are mostly driven by what the market expects down the road.
Okay.
And what seems to be grabbing more and more attention from bond investors is just the sheer size of the U.S. national debt. We're talking over $36 trillion now. And the deficit just for fiscal 2024 was over $1.8 trillion.
Wow. Those numbers are just huge. Hard to even wrap your head around.
They really are. And it seems the market is starting to weigh that debt burden more heavily, especially now.
So the size of the debt is becoming a bigger worry for investors.
It seems that way. And the Motley Fool piece really stresses this isn't happening because everyone suddenly thinks the economy is booming.
Right. We already established that. Rate cut expectations are still there.
Exactly. The tariff uncertainty is still hanging around. So if it's not a belief in strong growth pushing yields up, what else is going on?
Well, the article brings up inflation expectations.
Mm-hmm.
And that makes intuitive sense with tariffs, doesn't it?
Yeah.
Tariffs make imports more expensive.
That's a huge piece of it. Tariffs are generally seen by economists as inflationary. They push up costs. And it's interesting, Fed Chair Powell initially kind of described tariff inflation as likely transitory, temporary.
I remember that.
But after these latest broader tariff announcements from President Trump, he shifted his tone a bit, warning the effects could be more persistent.
Okay, so not just a blip.
Potentially not. So these rising long-term yields, they could be the market basically saying, hey, we think there's a higher chance inflation sticks around for longer now. Even if the economy slows down because of the trade friction, we might still have higher prices lingering. And higher inflation eats away at the value of the fixed payments you get from a long-term bond, makes them less attractive.
Gotcha. So it's like tariffs could slow growth and boost inflation. A nasty combination for long bonds.
Precisely. That's a big part of it. And then there's another factor the Motley Fool mentions. The sheer amount of U.S. debt that's maturing, coming due pretty soon.
Oh, how much are we talking?
According to the Treasury Department data they cite, it's about $6.15 trillion maturing between now and March 2026.
$6 trillion. That's a lot of refinancing the government needs to do. How does that feed into yields?
Well, think about supply and demand. When all that old debt matures, the government has to issue new bonds to replace it and cover ongoing spending. If you suddenly flood the market with a huge supply of new bonds,
prices might go down if demand doesn't keep up.
Exactly. Downward pressure on prices. And remember, the seesaw, lower bond prices mean higher bond yields, especially if buyers aren't super eager to snap up all that new supply.
Okay, that makes sense. More supply, potentially lower prices, higher yields.
Yeah.
The article also mentions foreign investors, right? That seems critical for U.S. debt.
Absolutely vital. Foreign investors hold about a quarter of all U.S. debt. Countries like China have historically been huge buyers, but the Motley Fool flags a potential risk here. With rising trade tensions, maybe some geopolitical friction, could these big foreign buyers become less keen on buying treasuries, maybe even start selling some of what they hold?
Ooh, that would definitely add to the supply pressure.
It certainly would. If demand from key foreign buyers drops off, that again could push yields higher to attract the necessary buyers.
And that risk feels more real now than maybe it did a few years ago. Didn't the article mention Jeffrey Gundlach's take on this?
It did, yeah. Jeffrey Gundlach, the well-known investor from DoubleLine Capital, he's been pretty vocal about this.
What's his view?
He basically argues that if the U.S. keeps getting into conflicts, trade or otherwise, with other major countries, why would those countries keep financing U.S. debt so readily? And he also worries about a potential recession. He thinks a recession could blow the deficit wide open, maybe even to $3 trillion. Combine that massive borrowing need with potentially weaker foreign demand. He predicts Treasury yields will actually rise during the next recession.
Wow, that really goes against the grain.
Yeah.
Usually you expect yields to fall in a recession.
It does. So based on that view, his advice is to avoid the long-term stuff, the 10-year, the 30-year bonds, and stick to shorter maturities like 2, 3, or 5-year treasuries instead.
So a pretty serious warning from a major bond market player. It really sounds like this combination of factors, tariff-driven inflation worries, the huge amount of debt rolling over, and maybe less demand from overseas is creating this upward pressure on long yields, even with the economy looking a bit wobbly.
Yeah, that's the core argument the Motley Fool is exploring.
It feels like that old idea of long-term treasuries being the ultimate safe place is being seriously questioned.
I think that's exactly right. The analysis really highlights how this asset, traditionally seen as super safe, might actually be carrying more risk now. Remember, higher yields often signal that investors perceive more risk.
Right.
And while nobody seriously expects the U.S. government to default, the sheer size of the debt does introduce what the article calls a remote risk. It just raises questions about the long-term fiscal path.
And even short of default, just the cost of paying interest on all that debt keeps going up, doesn't it? Taking up a bigger slice of the budget.
Absolutely. That crowds out other spending and just makes the fiscal picture look less healthy. And this isn't just abstract worry. The Motley Fool mentions Moody's recent analysis.
What did Moody say?
They specifically pointed to the waning fiscal situation and didn't rule out a possible credit rating downgrade for the U.S. down the line. We saw S&P do that back in 2011, remember?
Yeah, I do. And that kind of thing can shake confidence, right? Maybe lead to higher borrowing costs for the government itself.
It can, yeah. It can potentially create a bit of a negative cycle. If perceived risk goes up, investors demand higher yields, which makes the debt burden even heavier. The article makes an interesting comparison to the regional bank problems in 2023.
How so?
Well, remember how fears about the safety of those banks, even if initially small, kind of spiraled?
Depositors got nervous and pulled their money out.
Exactly. It became a self-fulfilling prophecy in some cases. The point is that confidence is crucial for any lending, even to the U.S. government. If that confidence starts to erode, even subtly because of concerns about debt or inflation or whatever else, it can have real consequences.
So putting it all together, while the U.S. is almost certainly going to pay its bills, this massive debt load combined with tariff inflation and maybe shaky foreign demand, it's adding a layer of uncertainty, maybe even risk, to long-term treasuries that wasn't really there before. They're not quite the bulletproof asset they once seemed.
That sums it up really well. The traditional role of long-term treasuries as the go-to safe haven, especially when the economy looks uncertain, is definitely being challenged by all these cross-currents right now. The tariffs, the inflation outlook, the debt itself, they're creating a much more complex picture for these bonds.
So for everyone listening, the key takeaway from this deep dive, looking at the Motley Fool's analysis, seems to be this. The interplay between tariffs, inflation fears, and the huge national debt is making the long-term U.S. Treasury market act in unusual ways. It might be riskier than many have traditionally assumed.
Yeah, it's definitely something to factor into how you think about investments and read the economic tea leaves.
Absolutely. It's really worth thinking about what this means for your own strategy.
And maybe it leaves us with a final thought to chew on. As this global economic picture keeps shifting, how else might these big forces, debt, inflation, trade tensions, change our ideas about what safe really means when it comes to investing?
A really important question, something to keep pondering.